What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and learn how to think critically about the systems of power shaping our world. My guests in this episode of Hidden Forces are Paulo Macro and Le Shrub, two very popular authors with large Twitter accounts who also publish their market commentary and investment ideas on paulomacro.substack.com and shrubstack.com, respectively. This is a conversation about not only ideas and investment frameworks, but also about process and how these two investors with 40 years of market experience between them seize investment opportunities and manage risk, including one of the largest risks of all, you and the behavioral biases that can so often lead all of us to make bad decisions at the worst possible time. In the first hour of our conversation, I asked Paulo and Le Shrub about some of their respective frameworks, including the EM-ification of developed economies and their political systems, and the need to understand the incentives of policymakers, how their toolboxes have changed in the years since the COVID-19 pandemic, and how that should inform your expectations about interest rates, inflation, credit rationing, and much more. In the second hour, we explore how the contemporary strain on the international system and on American military and financial hegemony could amplify some of the budgetary and political headwinds facing developed economies in the years ahead. We discuss the conundrum facing policymakers in China, the investment opportunity in commodities, the search for a new safe asset in a world of worsening fiscal balance sheets, and what it feels like to be financially gaslighted during an inflationary recession where prices rise as your living standard declines. If you want access to that part of the conversation, and you're not already subscribed to Hidden Forces, you can join our premium feed and listen to the second hour of today's episode by going to hiddenforces.io/subscribe. All of our content tiers give you access to our premium feed, which you can listen to on your mobile device using your favorite podcast app, just like you're listening to this episode right now. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, which includes Q&A calls with guests, access to special research and analysis, in-person events, and dinners, you can also do that on our subscriber page. And if you still have questions, feel free to send an email to info@hiddenforces.io, and I or someone from our team will get right back to you. Lastly, because this conversation deals with investing, nothing we say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guests are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, please enjoy this highly entertaining, thoughtful, and educational conversation with my guests, Paulo Macro and Le Shrub. Paulo Macro and Le Shrub, welcome both to Hidden Forces.
Great to be here.
Good to be back. You remember the last one? What did we called it?
We called it the best. What was it? The best investment
podcast
the worst
ever.
Right.
But now we have Paulo on, so we're going to make it the best one.
Exactly. So it's great having you guys both on. Le Shrub, you were on last summer. I think in August we did it in studio in Athens, right?
Yeah, it was a face-to-face, and it was a turning point in the markets. We had a bit of a bearish stance back then. I think that things were getting a bit too hot, and there was a correction afterwards. And then the policymakers took a decisive stance in October and got us where we are today.
So we're going to have a chance to talk about that. Paulo, you haven't been on the podcast before. So I'm going to have both of you have an opportunity to introduce yourselves to our audience. But Paulo, since you're going to be introducing yourself for the first time, I would love to have you just tell us a little bit about who you are and what your story is. And also, both of you, this is relevant. People that heard Le Shrub's episode know, and these are anonymous names. He's got an anonymous Twitter account. Like a number of really smart people in the modern age, they have Twitter accounts that they interface with. You guys both have Substacks as well now. You're also an anonymous account on Twitter. So tell us a little bit about who you are, what your story is for those who aren't familiar with you or your work.
Thanks, Demetri, and real pleasure to be here. Thanks so much for having me on, guys. My background can probably be best summarized as just over 20 years in finance in an assortment of roles. I'm a little bit of a misfit toy in the industry in that I've pivoted my career over the years a few times. It started in the early 2000s in a global macro role on the sell side with a major bank, and then moved to the buy side to a group of mutual funds focused on international equities as an analyst. Moved back to the sell side for the big trading floor fund at a major bulge bracket bank that morphed into kind of more of an original ideas cross-asset role with a focus on commodity related equities. And following Lehman, moved back to the buy side, this time as a marketer raising assets for hedge funds. And didn't particularly like that role, although loved the people I worked with and learned a lot. Sort of went to hedge fund college behind the scenes, helping managers raise money. And then from there, I spent the last 10 years focused on Latin America. As my name, Paulo, or pseudonym implies, my background and passion really is for the macro and understanding how the big picture meets the bottom up. And my background is Brazilian. My parents are from there. So I grew up speaking Portuguese in the house and kind of a foot in both worlds. I live in New York. I'm born and raised in New York. So I'm a rare breed of New Yorker who's actually from here. But with the Brazilian background and the dual citizenship and the passport and the sort of up close understanding of Latin America and Brazil, and my focus in the last 10 years was as a Latin America specialist, again, for major banks. So I've moved around a little bit over the years and put different sort of perspectives in my experience set in my bag. And today now sort of a free agent with an interesting year of transition ahead. And earlier this year, right around the time Shrub did something similar, I moved over to Substack after a few years of getting to know people on Twitter, really out of a desire to write more long-form, free-moving thought pieces. It was something that I particularly enjoyed when I worked for banks and hedge funds, and very happy doing it today while just focusing on managing my own money.
So when did you start tweeting? I know you've had the account since I think 2013, but when did you actually start like putting content out on Twitter?
A couple of years ago, really, I think got more active after COVID. You know, we're all shut in our rooms, waiting for the world to end, wondering when we can come back out. And for me, it was a weird departure because at the time I was working as a broker for a bank, and suddenly being thrown into a full Zoom work from home environment, you start to want to reach out to people, and Twitter ended up being a fascinating way to connect, and sort of discovered from there variety of individuals from sell side and buy side and all over the place globally that were exchanging ideas on the macro, on individual equities, on credit. And it kind of grew from there, really out of nothing. I started with a couple of dozen followers, and I'm still shocked that people find it interesting, but managed to meet a lot of interesting people over the last few years doing it. But it was really around COVID. I tweeted a little bit before COVID on a couple of particular subjects, but never really developed much of a following or a real close engagement with the platform until after COVID hit.
And Le Shrub, what about you? I said, you were on the podcast. We did an episode in August. It either published in late August or might have been September. I don't remember when the Athens dinner was exactly. I think it was in August, but we might have published it in early September. But for people that haven't heard that or who might just want a refresher on who you are, what's your deal? Kind of what's your story?
Yeah, sure. So I started I did a brief stint in investment banking just to learn the basics. And then I was lucky enough to move to a hedge fund in 2006. And I was working for one of the big shorts, one of the famous people in the Big Short. So I spent the next 5 years at that hedge fund going through, the whole subprime crisis, but also going through the recovery. And both were equally useful lessons for what came after, obviously. But, my background is in special situations, event-driven investing. And this was the driver of all our trades, including the Big Short and including the recovery trades. And then after that, I spent the next 10 years again in hedge funds as a portfolio manager, and lately running a family office, again with a very flexible mandate. And And I think what changed in the last few months, I've actually decided to write more and stay at home and spend more time with the kids for the next few months. I actually had like a little existential crisis that I didn't spend time with my 2-year-old daughter before she goes to school. So I decided to just take a few months off from managing other people's money after 16 years. So I'm just running my own portfolio and running after the kids for now. And in the meantime, it just gives me a chance to write more on Substack, which I'm actually really enjoying because it's just helping me frame my thoughts in a more clear way. Like I just try to write in a way that people can understand and relate. And it's kind of my trading diary. And it's, I try to make it funny as well because it's, you need to have fun while you're doing this.
So it's actually something I wanted to ask you guys. How much of your writing and communication, public communication, is something that you do because of the benefits that come with it?
It's 100% beneficial to my process.
So that's the driver for you. It isn't necessarily that it's enjoyable in and of itself that makes you want to do it.
I'm enjoying it at the same time, but I find it very beneficial to my process. That's why I started tweeting, because it's kind of weird, but I started tweeting my trade ideas, and I noticed that the trade ideas I was tweeting out had a much higher hit ratio than the trade ideas I wasn't tweeting out. And I realized it's because I was feeling like, I felt that my tweets were going out to an average person, and I kind of didn't want anyone to get hurt by a stupid trade or something. So maybe subconsciously, I was just only sharing my best ideas that had a high probability of success. Just thinking like on the other side of the tweet could be like an old lady reading it and, does something stupid with it. So I found myself sharing, like having a very high hit ratio on that. And then whatever I wasn't tweeting, maybe I was a bit more lazy about it. So I had a lower hit ratio. So that's what got me to write more and more because, I just feel like I'm being more responsible almost because, at the end of the day, when you're in a hedge fund, you have a team, you brainstorm with each other. So that brainstorming creates an investment process. But when you're trading by yourself and your own portfolio, it can be quite a lonely process. And that's why, I call Paulo once in a while, we just catch up and we brainstorm because we're kind of recreating the same thing. But, that's the important thing about writing. You put it on paper and you become more accountable as well. So I've actually found out that, I started writing in October. And the reason why I sat down to start writing was because if you remember, towards the end of October, there was the big pivot of Yellen and Powell. So I think at that time, yields were blowing up to 5%. The market was at its lows. Duration was getting sold off. Biotech was getting sold off. So I actually thought that was like a great opportunity in buying long duration, buying biotech, which I affectionately called the biotech Rosemary's Baby because it's kind of like devil's offspring of long duration in some ways. Like that's why it's long duration, like a Rosemary's Baby. So anyway, so it got me to think, what, this is a great opportunity. I want to put it on paper. So that helped me to frame my thinking. And that's when I bought a lot of those things and it worked out. But actually that's how I started writing long form because it kind of, I saw the opportunity. I wanted to put it on paper. That's how it started really. And I kept going. I thought that I would run out of things to write about, but actually, this market just gives you something to write about all the time.
Well, what's great is that you have such a unique voice. Paulo, would you say does Le Shrub's explanation capture the reasons that you write? And how much of that is actually something that you enjoy and maybe you would do irrespective of the benefits to your trading and investing?
Yeah, he's spot on in more ways than just the writing. We both have kids around the same age. So our lives are sort of kind of charmed here in the sense that we get to do what we love, which is observe and transact in the financial markets and write about it for people who care and want to read how we think, but also spend more time with our families. It's amazing where we were just a few years ago and having this kind of independence at a time when a lot of people barely see their kids. So I'm for one very grateful, and I know exactly what Shrub is getting at in terms of that side of the picture. For me, the writing, as he also laid out so well, is part of the flywheel of operating better in the marketplace. I tend to find, you'll hear other people say this as well, but writing something down kind of immortalizes it or keeps you honest. Sometimes you have a million thoughts running through your head, especially with markets as wild and interconnected as we have today in macro, and it's hard to keep your thoughts straight. And if I wasn't writing for others, I would be writing in a diary just to try to keep myself honest about what I was thinking when. The idea that you can have this sort of digital trail that, at your fingertips, in 10 years, we're going to look back at these post Shrub and just facepalm our foreheads and be like, what were we thinking? We were playing JV ball, weren't we? But right now it's so helpful because, and I also say this as someone who learned to write late in life. English was always my worst subject, writing and composition. And despite having sort of multiple languages in my life, I had a lot of mental blocks as a writer early on. And I learned to write almost overnight from a college roommate who sat me down, looked over my shoulder at me struggling with a 1 or 2 pager. And he said, listen, throw all this away. What are you trying to say? And I told him, and he was secretly recording me, and he played it back for me. And he said, this is perfect. Now literally write down what you just dictated to me and don't change a thing. And it was like something clicked. Suddenly there were no blocks because I was speaking what I was thinking and I was writing what I was speaking. And as long as those 3 things, think, speak, write, are in alignment, you can write well. The added trick that I've only grown to appreciate over the last few years is that the more I write and think about the market, the better my speculations seem to get. And then those, developments in the marketplace and in my own trading and investing boomerang back on more of a desire to write, and around we go. So writing is absolutely essential for me in terms of the flywheel of being able to think well and then operate well in the market.
So what about conversations like these, and further to the point, podcasting in general, because you guys have a podcast that you do together. As far as I know, unless I missed a recent one, you released 2 so far where you guys basically get on a call, you riff, you exchange ideas. It seems like that is in some ways really just a publication of a private process that you guys go through. Like Le Shrub was saying, he'll give you a call, you guys will exchange ideas and think things through. How useful is that? And is that what also led you to launch the podcast?
Yeah, so basically, I've been speaking with Paulo for a while, and I really enjoy exchanging ideas with him. I have a lot of respect for him, but also, the reason why we speak is because not only because we're aligned, but actually it's because sometimes we differ. I find that we sometimes have the same ideas, but with different timings. So when something big happens, like when there's a major event, we would just speak about something. And then at some point we were like, dude, why don't we just record it? I mean, we just record it and we put it on Substack. I mean, we have these conversations anyway, so let's just record one of them and just put it on. So I can't remember what it was, the reason for the first one, Paulo, but, we recorded it and we riffed around it and, we really enjoyed it ourselves. And then there was another incident, I think it was maybe after the inflation data and during Yellen's visit to Asia or something, and we recorded another one. But the whole idea behind it was, we called it the fly on the wall. So it's basically Paulo and I having a phone call and just recording it and sharing it with our readers.
Yeah, it's amazing in 2024 what you can find at your fingertips to kind of, open or replicate certain environments. Like it used to be that if you wanted to build, a real intellectual horsepower, you would hire some of the sharpest analysts you can find and put them in a room. You'd have the morning meeting. You'd all have to be in the same place. And then every once in a while, you'll chat with your buddy who runs another fund and trade notes, compare an idea. The idea that someone like Shrub and I can not only strike up a friendship from other areas of the world, but then get to know each other and start riffing as if we were fellow investors in situations. And we, despite the fact that we have a lot of similarities in some of the stuff we write about, and we tend to agree more often than we disagree. Where it gets interesting, as he said, is we come at situations very differently sometimes. And that's, for me, the real value add is not only do we interface great, and I happen to really like Shrub on a personal level. I think he's terrific and all around great guy, but a guy who you feel like he makes you smarter And just trading notes and thinking out loud, again, is part of the process that helps you be sharper in the market. And it's also nice to have a few allies who, when you're having the inevitable tough day and getting blasted in the market, like you can call up and be like, man, today really kind of sucked, and then you shake it off. And so much of what we do is emotional self-control and focus that you really want, guys that you feel like you can depend on in bouncing ideas off of. And he was right. Like, it was actually his idea. He's being modest that it would be a great idea just to record it. And it's helpful too, because I went back and listened to one of them. And not only did I find myself smiling at some of the funny stuff, but it's, again, like in the spirit of keeping a diary, it's a great way to go back and hear yourself talking with someone else about what was going through your head at that point in time. I just can't imagine having this kind of replication 10, 15, 20 years ago. There's so much power in being able to communicate with someone like Shrub and save it for posterity, and then share it with people who seem to get something out of it as well. Again, it keeps you honest. It helps me trade better.
Yeah, that's invaluable. I've had a few different people in my life over certain periods that I've called on a regular basis. And I haven't had someone like that since before the pandemic. And I feel like for me, the quality that I look for in someone like that, besides like very smart, someone that's very intelligent and knowledgeable, is also someone that's deeply curious and humble. Because even though like we talk about humility in general and how valuable it is on this show and as a quality trait, I think in private, where, there's less consequences to not being humble, maybe there isn't some direct decisions that's coming out of it, but there's something about having that kind of humility in those kinds of conversations that allows them to be really useful, because you're talking to somebody else who also doesn't have the answers and knows they don't have the answers, and they're trying to figure out, and they're also excited at the prospect of figuring it out. And now with these like AI note-taking apps, I mean, before, like if you recorded these conversations, well, I don't know. I mean, how many people are actually going to go back over time and kind of sort through, this is what I said, then unless you're like some really great note taker. But now, like, I just feel like we're on the cusp of just a huge change in intellectual productivity. And for people like us that deal in ideas and kind of thinking through problems, it's just going to change our lives in ways that I just think are difficult to imagine.
Yeah.
Yeah. Since you mentioned humility, by the way, I'd like to think that after 20 years in the markets, both Paulo and I have been humbled enough by the market to just acquire a sense of humility to respect the market itself. So I think the market is what would be the right term, Paulo? Is it like a humiliating mechanism, or or it's a humbling mechanism? It just, it kind of grounds you. Like, I've seen very wealthy people being humbled by the markets. And I mean, I've been humbled many times, and I constantly am being humbled. But I think it's like, how I compare the market to the sea, because, I come from an island, I love the sea, and the sea has to be loved and respected at the same time. And the market is in a way very similar. It changes its moods, it has its storms and it has its calms, but, it has to be respected. And, you have to go with the flow when it comes to that.
Yeah, I'm still paying tuition to the market, and I'm trying to set up my life. And I do this consciously, where I've taken so many hits over the years in my P&L, and I tend to run a lot of vol. I have a very high tolerance for risk. That's wildly inappropriate for most people. And I tell that to people up front. But in that context, you have to take the punches with the good. But I also find with experience that certain behaviors that I exhibit at certain points in time are very good red flags for when something is about to go wrong. And now that I'm aware of those things, and it comes down to like a simple cheer or a chest thump even. I took a very large loss last year. I had a good year, but it was a great year that ended up being a good year. And which is an unusual kind of feeling, because, hey, like, what are you complaining about? You still had a great year. But the money that was left on the table, I know exactly how I lost it. And afterwards, in talking about those losses with Shrub and a couple of other people, I'm trying to set up in my life. I literally told these friends one-on-one, I never imagined that the tuition could be so expensive. And a good buddy of mine responded with, yeah, if the tuition weren't egregiously expensive, you wouldn't learn the lesson. And that was a big takeaway for me in managing risk and getting out of a loss early. But the other one was, and I told this to a few friends and they thought I was kidding. I said, no, I'm serious. If you ever see me this confident around a dinner table or over drinks again, you need to call my wife. You need to tell her what I just did. And she needs to walk me to the computer and start trading at, like, forcing me to trade out of stuff. I need you to do that for me to protect me from myself. Like, don't ever let me be that confident in my positions ever again, because the loss is literally right around the corner. And people thought I was kidding. I have that arrangement now with more than one person where they will call my wife and get me out. And I need that, because this market will destroy you emotionally and put you through hell. And the only thing you have at the end of the day is the humility to accept that you are going to make mistakes. These mistakes will cost real money, and just insulate yourself at every turn from your worst self so that you have a shot at, really taking money out of the market over the long run while keeping your sanity and remaining a good person, At this point, if anything happens to me that really starts to screw with my emotional equilibrium, I just start getting out. Like I have a huge tolerance for risk, but I also have I have a dwindling tolerance for things that really screw me up mentally.
Who is it that I've heard you quote saying that whenever he gets a certain feeling, whether he gets too excited or too overconfident, he like literally goes and lies down until the feeling passes?
That's an old market wizard, predates like the Commodities Corp guys. There was a trader named Stanley Kroll, and he was quoting someone else where he was saying it more in the context of there are certain commodity futures that he just doesn't understand. For him, it was platinum. And so he says, like, whenever I feel like trading platinum, I just go lie down until the feeling passes.
I love that.
That's more tongue in cheek. Like, but there's actually a lesson in that exactly to this point. Like, know yourself, know that you are tempted to speculate on stuff that you lose money on more often than not. And that your best course of action in that corner of the market is just not to be there and force yourself to stay away. And it's tongue in cheek, but it's hilarious the way he thinks about it, but it's also so true. Just protect yourself from yourself.
When Paulo told me that thing about the platinum story, I freaked out because platinum, I'm very bullish platinum, and I was very long platinum when he told me the story. I'm like, oh my God, I'm so bullish platinum, and now Paulo just messed my brain. But as an aside, Soros said the opposite. So Soros, he said whenever he was feeling a bad back or a pain in his back he would just go and close all the positions. Yeah. So this is the opposite thing. I think it's just a question of knowing yourself. Like Soros is obviously the god of trading. So Soros's built-in algorithm was telling him trouble, and that was exhibiting through a pain in his body. Whereas in my case and Paulo's case to a degree, actually we are getting overconfident, right, Paulo? So we're building up our confidence, and we have the opposite effect. But after years, you kind of know, damn it, I'm getting a bit too confident. I need to just pare back my risk. But it's just funny how it exhibits in different ways to different people, and it's all just about knowing yourself and protecting yourself. Like my default mechanism is when I feel something is going wrong, I sell a lot of stuff and I just increase my cash position. And I keep writing about this, that, I feel as cash is my hedge. When I feel uncertain, I just pare back and I just observe.
So let's do some observing. I'd love to get a sense of kind of where each of you are focused right now, and what are the big macro questions or themes that you've been focused on, and what are the narratives that you feel are either appropriately descriptive of what is going on or maybe have it wrong and you guys are taking an opposite tact on it. So maybe let's go with you, Shrub. Kind of where has your mind been at recently? And, what are some of the areas maybe where you and Paulo are in agreement?
Yeah, sure. So since the October-November pivot of Powell and Yellen, I've been framing it like this, that this is a re-election cycle. And the policymakers are just incentivized to get their candidates elected. As simple as that. So, I affectionately called policymakers Tamagotchis, like that Japanese toy, because the Tamagotchi has a very simple reaction function. So, in the case of a policymaker, they want very simple things. Like in the case of Yellen, for example, in October, why did she pivot? She pivoted because the 10-year spiked above 5%. So her reaction function triggered and said, I got to get the 10-year below 5% because I need to get my candidate reelected. So simple as that. So what did we see since the November pivot? We saw a very determined Treasury and a very determined Fed, whereby they're just trying to do everything possible to patch things in the financial markets and create a stability, low volatility until the election day and get people incentivized to vote for their guy. They did that through various ways. They issued more bills than coupons in the quarterly refunding announcement. They drew down the TGA. They, all sorts of tricks that we didn't really care before. Or, now they're doing a QT tapering. So they're quantitative tightening. They're tapering quantitative tightening from 60 billion to 25 billion. Because, what's the most visible problem we have right now is we have a big deficit of more than 2 trillion a year. So by doing patchworks like tapering the QT, that by itself reduces supply by about 400 billion. I mean, that's not a long-term fix. It's a short-term fix, but it kind of like reduces volatility in the bond market until we get to election time. So my framework was observe what the policymakers are doing. And it's not just on the monetary policy side. It's also on other policies. For example, at the beginning of the year, I bought cannabis stocks because I saw that almost 90% of Americans were in favor of marijuana reform. And I was expecting policymakers to be very driven to reschedule marijuana from Schedule 1 drug to a Schedule 3 drug, which they're in the process of doing. And, the marijuana stocks had like a 50% rally since, but that's just a function of policymakers being driven. The other sector that, again, which was more on the not on the monetary side, was immigration reform. So, the prison stocks that had a very big run as a result of immigration being a major problem that they're trying to tackle. And the other thing that just came up, which I think is very, very, very important, and I'm shocked that it appeared only on page 14 of the Financial Times this weekend, is that there is a possibility for a major housing reform whereby Freddie Mac applied to the FHFA, the Federal Housing Association, to offer secondary mortgages to people. So just to make it simple, right now, the Fannie Freddie, they only offer primary mortgages. And there's a lot of equity that's trapped in the housing market. Now, if you have a mortgage with Freddie, what Freddie wants is they want you to come to them and you take an additional mortgage at a favorable rate and you release equity from your house. So Meredith Whitney wrote this article that was very eloquent where she said, look, if this passes, it can add $1 trillion of consumer stimulus in the economy. And if Fannie also joins in, that could add $2 trillion of consumer stimulus by the end of the year. And, the funny part is it doesn't need Senate approval from what I understand. There's like a 60-day consultation period. And if the FHFA does not block it, then this will pass. So this is basically Freddie Mac and FHFA becoming political again, just in line with the policymakers and providing what could be a significant consumer stimulus in the economy, just in line with the re-election cycle. Why they're doing it now? I really think it has to do with where we are in the election process because, right now the housing market is very, very tight. We're still trying to tackle inflation. So this doesn't really do much except make homeowners very happy. And I think it's more than almost 70% of Americans own a home. So it's obviously very, very beneficial for consumers. So in summary, that's where I'm at. I'm thinking about it in a very simple way because, I want to have a framework that helps me invest. And also, I found that simple things make the best results. It's a very simple thing. It's a re-election cycle. The policymakers are very incentivized to keep this together until the election. After the election, that's a different conversation we can have later. But until the election, I think everyone is motivated to just keep this together.
And Shrub and I actually, our views come together around a lot of what he just said in an interesting way. I'm happy to accentuate on some of the points.
Sure. Yeah, well, I'll tell you what I was going to ask, and then feel free to add to it. What I was going to say is that this kind of seems to kind of fold into a framework that you have. You could refer to it as, I would call it America's becoming Brazil. That's sort of the way I think of it. But it aligns with a more emerging market framework where in countries where you tend to see this in countries with weaker institutions, where there's more patronage and currying favor through the political system to interest groups in order to get reelected. This isn't something that I feel like we've seen to this degree. Of course, we've seen it to various degrees in the United States, but it seems like it's more true today and that the gloves are off in a way that it wasn't the case before. And I'm curious in your answer if you can incorporate some reflection on that, and to what degree does this actually align with this larger framework that you have, which is that in order to understand the U.S. economy and financial markets today, it helps to understand emerging markets, because a lot of what we've seen in EM, we're seeing now in developing countries.
100%. Actually, that's where I was going, because with Shrub's sort of conceptualization of political expediency driving so many decisions, and I suppose on some level in the term political economy, the word political comes first, but we sort of ignored that in 20 or 30 years of a structural bull market in America's exceptionalism, our equity market, our bonds, which the world couldn't seem to get enough of over the last 40-ish years. And here we are at a point where debts have, certainly in the public space, have grown to an unsustainable level between what we've already issued and the contingent liabilities that we've promised, particularly to the boomers. And actually, to Shrub's point about the housing reform that is being discussed, these are real numbers. The interesting thing to me, on top of everything he mentioned, is that millennials, their household formation is going through the roof right now. The tip of the millennial spear is sort of just crossed 40. And people waited to get married and have a kid in part because of the great financial crisis in 2008. That kind of delayed things from a household formation perspective. But now, like the rubber meets the road. If you're a millennial and you even remotely thought about starting a family, like the clock's ticking, right? And yet the profile of the American demographics is fascinating, because you have 20% of Americans are boomers. The millennials are a bigger cohort, around 25-ish%, but boomers have over half of the net worth of America and the asset base. So no wonder you're hearing more stories of millennials buying their first home with help from their parents. The boomers know that they have to let go at some point. And if they don't help their kids, the government's going to make them through wealth taxes down the line, through dropping the inheritance tax ceilings from the 13 million or so down to 2 or 3. The wealth will be transferred one way or the other. But we're also looking down the barrel of just exploding contingent liabilities on the Social Security and Medicare side that are just starting to move through the big part of the bulge, the plateau of boomers from 1954 to 1959-ish. And the beauty is boomers vote in droves, right? Because it's their goodie bag. Young people tend to vote far less than older people. And who does this housing program target? The boomers, who are probably down to 20 or 30% LTV. They're in their 60s, 70s. They pay down almost the entire mortgage. And now the government's literally saying, well, your house price exploded and you're in the kind of salad years of your life. You're probably about to take retirement. And here's another couple of $100,000 from Freddie Mac that you can borrow against your house. And you don't need to worry about that debt, because like when you die, the bank will just sell the house to get their money back, and whatever's left over passes to your kids. Like, the boomers always win. And this is another case where, because they vote in droves, this policy is going to be wildly effective in buying votes, because people can now go out and we're reliving the 2000s second mortgage HELOC phenomenon where people borrowed insanely against their homes. And now you're telling people you have all this untapped equity in your home. you've always wanted an RV. Like maybe the time is now. Like you've only got another 10 or 20 years and you can't take it with you. So go have some fun in your twilight years. Like everything that Shrub said. And then you think like, man, this actually benefits the boomers more than anybody because they're the ones with the untapped equity. Yeah, stuff like this swings an election. To come back to your question about my framework, some people call it the EM-ification of the West. We've lived for a long time in America, certainly since the great financial crisis in 2008, in fear of Japanification in the US, that demographics inevitably were going to follow Western Europe, Italy, Japan, down into the kind of twilight. From there, the debts are unsustainable. The country is low growth, no growth. How do we avoid the kind of perennial disinflationary, deflationary trap that the West seems to be stuck in? And then COVID changed everything. It's taken a while, surprisingly, for people to come around to the view that the fiscal really matters. And when the fiscal starts to matter more than monetary policy, usually the two are sort of in balance, then you end up quickly, especially considering the size of the initial conditions of the debt, in a place where we start, yes, we still have the seigniorage and the privilege of the world's reserve currency, but we know from history that that doesn't last forever and that capital centers move around the world over time. Capital moves to where it's best treated. And if capital is getting abused through tax policy, fiscal policy, monetary policy, or all of the above, capital will start to move. The concept of fiscal dominance, where the fiscal, imagine two people sitting in a rowboat and they're rowing in opposition to one another. The fiscal is this huge Arnold Schwarzenegger at this point, and still is, who's rowing massively while you have Jay Powell and team at the FOMC rowing in opposition, trying to restrain the inflation in the system from the overconsumption and excess demand created by the insane borrow and spend on public accounts. And there's only so much that he can do. And this is an experience that Brazilians, Turks, South Africans, and other EMs know very well. It doesn't end in, outright disaster and the world ends and like, where do I move to? Like, should I buy a gun? Life does go on, but it's not actually an experience that Americans are familiar with. And certainly nobody alive here who's never had any kind of an experience in these sort of frontierish emerging markets that are profoundly cyclical. But they're learning. And just the fact that people now start to know what fiscal dominance means and that it's gaining attention suggests to me that this is a longer term trend that is catching fire and is changing the way we need to think about managing risk. It's changing long-term trends. There's a lot of money to be made as capital shifts amidst those trends. And the vast majority of people will take a long time to figure this out. The people who get there first and get the joke early will probably make the most amount of money.
Can I just add something here actually on Paulo's thing? Because my old boss used to say something that really stuck with me. And he said it in 2008. He said, every crisis is different. And because as investors, we have this recency bias about what we lived through. So I think as a result of most investors being scarred by 2008, I mean, people our age, a lot of us were scarred by 2008. There's a lot of current market participants that still expect the next crisis to be 2008. And it's not, because the toolbox has changed. The incentives have changed. The policymakers discovered QE, the monetary authorities discovered QE, and the fiscal authorities discovered they can get away with 6% deficits. So the next crisis is going to look completely different. That's why, I really appreciate Paulo's view emerging markets framework. And, the funny thing is, he said that we were afraid of Japanification initially, but, look at what Japanification is today, not what it was before. Today it is covert depreciation of currencies, covert debasement of currencies, negative real rates, a form of yield control, and then pretend that you care about your currency. So, today the US has positive real rates of 2%? Well, the Japanese have negative real rates of 2%. They're doing yield curve control. and they pretend that they care that the yen has depreciated by 30%, but actually they don't really care because the exports are doing better. So, Japanification of the past is very different than the Japanification of today. It's actually, Japan is also stealing a bit the emerging market.
It's so funny,
playbook.
Shrub, this is not your father's Japan,
Exactly. Not your father's Japan. But they're doing it so eloquently because, they're a developed market. They're saying, we're going to intervene. We can't stand having the yen at 155. It's like, guys, if you don't want to have the yen at 155, why don't you raise your rates by 200 bips because your rates are currently at 0? So this is it. Why, you have a country with 0 rates, negative real rates. They could have arrested the decline in the yen just by raising their rates, but they're not doing it. They're saying, we can't have our yen depreciating. It's like, yeah, because you actually want to deflate your debt away. Is it difficult to imagine a future in the US that looks a lot like that, where we have negative real rates and they just pretend and they just deflate their debt away? I mean, that's not a 2008 scenario, right? That's like the complete opposite.
Right. And the reaction function of policymakers as well, the classic generals fighting the last war. Look at the clear bias with the FOMC. The moment things get a little shaky, it's whoops, like we need a new line of credit for X, Y, and Z, or boy, maybe it won't be 7 cuts this year. It'll be 3 or 4. Like, how about hikes, guys? Like, you want to get inflation back in the box and wrestle the bond market into submission and try to kick the can down a little while. Why not just stop talking completely and say it's all on the table? The playing field is wide open for monetary policy going forward, including the right tail. Like, if we have to take it up again in the second series of rate hikes, but people are starting to get the joke on the political side as well. The bias is clear that these guys are still worried about 2008 coming back, right? The captains of industry are still biased towards rates are going up, but they'll always come back down.
The US media always says, Powell does not want to be like Arthur Burns. And I'm like, guys, Powell also doesn't want to be Trichet.
Yeah.
Do you remember Trichet? I mean, Trichet was raising rates during 08. So it's a fine balance. And I think policymakers would prefer to be Burns than being Trichet. And by the way, this is why you and I are bullish commodities, right? Because you want to hedge that tail where they just say, you know what, screw it. We're not going to hike rates. We're just going to cut rates. That's why you want to be long some real assets as a hedge.
And the bias here goes back a long way, right? You remember under Bernanke, he said several things that still kind of echo in history, like, contained in talking about subprime. But as they started to, do QE full bore coming out of the crisis, his big thing was, if inflation becomes a problem, we can raise rates in 15 minutes. It's like, wow, you are so confident you can get that genie back in the bottle. Have you ever been to Brazil or Turkey? Because when the fiscal is rowing against you, it takes a little more than 15 minutes, buddy. But it's okay now. We went through transitory for 1.5 years and it's all under control. Like, good job. I don't know. I've seen competent and incompetent and experienced and inexperienced central bankers. I think there's a real lack of institutional knowledge at the Federal Reserve. But a lot of lip service being paid to the Arthur Burns mistakes of the 70s. And these guys don't realize even what we're going through now is not the 70s. This one feels a little different to me, although I didn't trade and live through the 70s, because, again, the initial conditions were different. At least, when Volcker jacked rates to the teens around the time I was born, the national debt was still 25, 30% of GDP. So the interest expense wasn't compounding at anywhere near the rate it is today. I mean, we're looking at potentially $1 trillion in 25 just in interest expense. Think about the amount of money that is in Saudi Arabia, Japan's, and the US savers' pocket. It's massively stimulative and self-defeating in terms of trying to right the ship on the credit of the United States for a country that funds itself abroad, which is the craziest part. So it's going to be a dynamic couple of years.
Not just that, but the spending needs are going up at the same time as the cost of borrowing is going up, and at the same time as the system that has provided the recycling of dollars internally to fund the deficits is coming under strain. So it does feel, and it's felt for some time, that we're moving towards some kind of singularity, and people feel this. And I think that underlying anxiety informs a lot of what we see also in terms of public conversations and in kind of some of the cultural exposés of like film and, like some of these apocalyptic films. Like people feel it, and it shows up, in our politics, it shows up in the economics, and it shows up in the geopolitical realm. I want to move us to the second hour, guys. Before I do, I just have a question, which is, it kind of goes off this point about Japanification. Are either of you familiar with a paper by Charles Goodhart and Manoj Pradhan from 2017 on demographics? They also published a book in 2020 on the subject. And I had Dr. Goodhart on the podcast. But are you guys familiar with this? Because they pushed back. I mean, they wrote the original paper in 2017. So this was in the thick of secular stagnation. But they pushed back against what was a popular thesis at the time, that aging demographics would have the same effect in the decades to come as they had in Japan's lost decades. They pushed back against the consensus view, in other words, that aging demographics are necessarily deflationary, by looking in part at the political incentives that may result in a world where real interest rates rise, inflation and wage growth pick up, and inequality falls, which is in line with Le Shrub's observation about using a government-sponsored enterprise like Freddie Mac to offer boomers second lien home equity loans or lines of credit. So I'm curious how, if you guys are familiar with their work at all.
I think it does make sense. I didn't read the paper, but I read something similar. It does make sense. I mean, this is actually how socialist countries work. I think Paulo is more suited to talk about this, but you look at Italy or extreme example, Venezuela. I think, Paulo, you probably know Venezuela. I think they're having like declining population, but they're highly inflationary environment, obviously. So the same thing is probably going to happen with Europe at some point, I would think. But Paulo, you know more about Venezuela than I do.
Yeah, I'm also not familiar with the paper and have not read the book. The thing I would kind of keep in mind in all of this, it's very easy to get depressed at the outlook for various of these trends because there just doesn't seem to be any sort of political appetite to really address the key sources of a lot of these imbalances and problems absent a crisis. I think it's Michael Hartnett from Merrill Lynch is one of my favorite quotes, likes to say that the markets stop panicking when politicians start panicking. And nobody's panicking in DC over the deficit. In fact, I don't think anybody discusses it at all outside of a handful of people because there's simply no appetite by the American public to address deficits because, money was free for so long. They just, I tend to think most people just think it grows from, drops from the sky, and that we can continue to live beyond our means while funded by the good graces of foreign creditors without consequence. And then one day the bond market will take notice or the dollar will take notice. And all throughout this, you have that hiss and, the radio white noise in the universe of demographics increasingly aging in the US, but you've also got the crosswind of immigration, right? Especially the broadening labor availability at the low end. And so there's a lot to keep track of in all of this, but I think we also had a saying on the desk when I was focused more on Brazil 10 years ago. For a while there, when Brazil was really going into the hole in 2015, somebody turned to me and said, yeah, Brazil is becoming Argentina, Argentina is becoming Venezuela, and Venezuela is becoming Zimbabwe. And I couldn't stop laughing. But then it occurred to me, like, there are different grades of this process, right? It's not like, oh my God, we're all going to die and we need to protect ourselves, buy gold, like we're going to hyperinflate. This process will take years of kind of rolling crack ups, occasional blowouts in bond yields, occasional corrections in the equity market, occasional rips in commodities. We're kind of entering a golden era of active management and portfolio management in that sense, because I could see a world where in 10 to 15 years from now, everything is exactly where it is today, sort of real price wise or nominal price wise, but it's been a very long and interesting road to nowhere. where you have 50% corrections in equities, you have commodities that triple and then come back. That's one world. There's certainly other worlds where commodities re-rack higher because the dollar is persistently debased and currencies don't come back when you've cut them in half or down 90 in real terms. It tends to be one way when you start down that road. But the idea of buy and hold of the last 40 years in duration in equities, especially in large cap US, let your sitting do the work. The autopilot that is, people's 401ks, especially the boomers, again, they win again, right? They've had 40 years of, 08 was nasty, 2001 wasn't pleasant, but we always come back and make new highs within, 2 or 3 years. So you get conditioned to think that the arrow always points up and to the right over time, and that your wealth will compound in real terms and give you more spending power the older you get because you just didn't do anything. You just sat there. Maybe the next 15 years looks like something very different.
Yeah. And if you want a little bit of food for thought of that, imagine the 60-40. So it's 60, the 60-40 portfolio. So imagine 5% of the S&P, I think, is NVIDIA. And if you put commodities and energy is probably around 5% as well. So imagine we do have that inflationary environment. The portion that's going to carry you out and help you is less than 1 of the max 7. So that passive portfolio is not going to help you out if we do get that, the environment we're talking about.
So that's what I want to talk about in the second hour, guys. I certainly want to talk about your commodity thesis, both of your commodity theses, but especially yours, Paulo, on whether or not we're transitioning into a commodity bull market, what similarities it may have to the 1960s and 70s. In other words, how instructive is that period to helping us think about what we're moving into today, this concept of rolling crack ups. And also, I want to go back and talk a little bit more about what we were discussing in the beginning of the conversation about weakening institutions, because, I think the way that we're used to dealing with problems in the United States is we kind of deal with them like adults. I don't want to be disparaging of emerging markets, but in general, what you tend to see is that countries that are successful have politicians that put forward long-term, more strategic solutions to problems. And while FDR was a populist leader, many of the programs that he instituted have stuck around, whether it's Social Security, some of the regulations, the Glass-Steagall that was passed in the early 1930s. And whereas emerging markets with weak institutions, it's much more like every election cycle is different. There's much more variability. And that higher level of variability is really bad for business because business people feel a lot of uncertainty and it makes it really difficult to invest for the long term. So that's something else I want to talk about in the second hour, as well as a number of other themes that both you guys talk about. For anyone who is new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second hour of today's conversation with Paulo and Le Shrub, head over to hiddenforces.io/subscribe and sign up to one of our 3 content tiers. All subscribers gain access to our premium feed, which you can use to listen to the rest of today's conversation on your mobile device using your favorite podcast app, just like you're listening to this episode right now. Guys, stick around. We're going to move the second part of our conversation onto the premium feed. If you want to listen in on the rest of today's conversation, head over to hiddenforces.io/subscribe and join our premium feed. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, you can also do that through our subscriber page. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. You can follow me on Twitter @Kofinas, and you can email me at info@hiddenforces.io. As always, thanks for listening. We'll see you next time.